Welcome to this week's live ASX strategy session. Thanks for joining me. Great having you with me for another show. Lots of interesting things to talk about with the ASX, the S&P 500, then of course all the commodities and your stock codes as well. Any stocks you'd like to have a look at, get those stock codes ready. We'll go through those in the second half of the show. As always, everything today, general commentary only, doesn't take your personal situation into account. Having been through all of that, let's get into this week's first chart. And starting off with the ASX 200. And well, a big rebound in the US stocks this week, but so far a fairly lackluster rally in the ASX 200. Is this a bearish sign for local stocks? I'll show you a key area of risk in a moment. And then over in the US, I got a graph that shows just how much fear is out there. I think you'll find it fascinating, but more on that shortly. But before we get to that, let's start with this latest price action here in the ASX 200. So last week we spoke about the breakdown. We spoke about the breakdown below this key support. You can see this blue horizontal, this key support that comes in at around 8,600. And we also discussed that the moving averages were starting to roll over, the 50-day and the 100-day moving averages. And we discussed how this wasn't a bearish signal on its own at that point, but rather an orange warning flag, which basically meant be alert, know where your exits are, but don't panic. The key to the situation was, and still is, what does the rebound look like? Will it be, or could it be a V-shaped recovery which rallies strongly like we saw back in April and like we saw back in August last year? Or might it be a shallow bounce that stalls? So why is the type of rebound so important? Well, the V-shape, that classic V-shaped recovery, well, what that indicates, that's a typical indicator of strong buying at the dip. While the shallow bounce, when you get a shallow bounce, it suggests a selling of the rally. And of course, bull markets are built on buying of the dip, not selling of the rally. It's still too early to say, but so far, the rally we've got is disproportionately shallow relative to the sell-off which came before it. And it's also stalling around this resistance point around 8,600, which used to be the support. The support, now the market's below, becomes resistance. So it's stalling around that resistance area. The danger here is the ASX 200 gets stuck around current levels and doesn't have a convincing rally back above the moving averages. So the sort of price action which would be concerning would be like if the market just can't really sort of like get through this resistance and just sort of like spends a couple of weeks stalled beneath there. And that'd be the sign that's selling. That would be a sign that selling was capping the rally. And when selling caps rallies below declining moving averages, well, then that opens, the risk then is that you do then get that significant breakdown and prices start trending lower. And that bearish trend possibility then starts to increase. Now, none of this has happened yet. This is just things to look out for. So let's take that off because it hasn't happened and it may not happen. But that's a sort of structure to be aware of when prices are below. When you're getting that proportionally shallow bounce, it's about trying to identify the structural shift from where dips are being bought. Like, during the upward trending phase, you're trying to identify the shift from where dips are being bought to when rallies are being sold. So that's why we look at this sort of what the bounce looks like so closely. And I think the biggest drag on the ASX 200 is currently the financials index, which of course includes the banks. So let's having a look at this. This is the ASX 200 financials index. And you can see the type of price action which I just described, in that it's had the sharp sell-off and it's had the shallow bounce. And I think with the price action we have here, it has all the hallmarks of a market that is, I think there's a good chance it retests its recent low. This is by all accounts a shallow rebound with that potential to retest the lows, and you can see the same sort of thing. Just looking at this chart, the same sort of thing happened back in February. You can see the sharp sell-off, the shallow bounce, and then it gave way to further falls. So that's not to say the same sort of thing's going to happen here. It certainly may not. But that's the vulnerability. That's the vulnerability that opens when you get a market which stalls and has a shallow bounce below moving averages, which have started to decline as we currently have. So it's a risk factor, not a sign of what's necessarily to come. So this has been the drag on the ASX 200, and I think this is why the bounce we've seen in the ASX 200 is struggling to gain momentum, and why it's getting stuck. Why it's getting stuck below this resistance at the moment. But I think it will take more than a drag from the financials to cause a larger decline, like a larger sell-off in the ASX 200. I'll show you why I think a big sell-off in the ASX 200 is unlikely at this stage. So that's the financials. Now let's have a look at the other big part of the market, which is the materials, ASX 200 materials index, which includes the big miners. And so we looked at this last week, and I said that what we have here, I said this is a bullish structure. And so not only are the moving averages rising, so I've got the 50-day and the 100-day moving averages, which are rising. Prices above the moving averages as well. So of course that's a bullish marker. But the other thing is the materials is also breaking out of this 3-year trading range. If I compress this a bit, you can see this big 3-year trading range. Prices are currently in the process of breaking free from that range. So when you look at all that, prices are currently consolidating around the rising moving averages. But I think the odds favour new highs in the coming months for the materials. And of course, materials is the other big contributor to the ASX 200. And at the moment, it's acting somewhat as a counterbalance to the financials. So we've got the weak financials, but we've got the strong but consolidating materials. I think without a downtrend in materials, I think it's unlikely the ASX 200 enters any type of lengthy decline. Also, an interesting thing to note is the difference between now and, say, March. So in March, April, we got that big sell-off in the ASX 200. Come over and look at what the materials was doing in March. The materials was below declining moving averages, which made it vulnerable. It wasn't acting as a counterbalance in that stage. It was trending the same way as the financials and many other parts of the market had that vulnerable setup below declining moving averages. That's not the case now. It's above rising moving averages, so that acts as a stabilizer, I think, for the ASX 200. Also, just having a quick look at the equal weight, the ASX 200 on an equal weight basis, because it tells a different story. It's telling a different story to the ASX 200. So while we've got the ASX 200 with a bounce that looks pretty unimpressive, the equal weight is showing a stronger buy the dip response. Like look at this rally. We've got this bit of a V shape to the rally in the equal weight, and that's largely due to the influence of the big four banks being significantly diluted when you look at the market or look at the ASX 200 on an equal weighted basis. This remains a 7% pullback following a 37% gain. Of course, something larger could develop, but that's not what the price action is currently suggesting. At the moment, it's suggesting this is a pullback within an ongoing rising trend. I think we should expect more consolidation in the near term, but I don't think we should be panicking to exit the market. I've sold several stocks recently, some at a profit, some at a big profit, some at a loss, a moderate loss. But overall, I'm still maintaining positions in the market. In fact, I bought some stocks in the last few days. I bought some stocks today. So basically, I'm managing this fall by sticking to my plan. And that's the thing, I think, with a good plan. We design it when everything is calm and things are moving along nicely and we're clear-headed. And then when things get difficult and prices start pulling back, we follow the plan, and that helps us avoid the emotional decision making that catches so many people out. Okay, so let's move over to the S&P 500. First of all, though, if you're getting some value from this, please click that like button. Please leave us your comment. Tell me what you think. Do you think this is going to be a shorter pullback or a deeper pullback? Is it going to be a correction? Is it going to get a lot more unpleasant? Tell me what you're thinking. Always interesting to see your thoughts in the comments. But please click that like button. Really important. YouTube shows other people the video, and if people are watching, I keep making them. So yeah, those likes are really helpful and important. So please do that. All right, S&P 500, and was that the end? Was Monday, Friday? It was last Friday the end of the pullback. I've got some interesting graphs to go through with you in a moment. They'll help. I think they'll help answer the question about whether the low is in or not. But first, it's interesting to reflect on how negative many people were just a week ago. Just going back to last Thursday when we had this big, you just see it here, this big opened high and then sold off through the day, coming in opening near the lows on Friday. Just reflecting on how negative many people were just that week ago. Some people were looking for a big breakdown, and there were signs of panic emerging in local stocks and US stocks. Just across the board generally, there were some of those early signs emerging. But here we are a week later, and there's a strong rally off the 100-day moving average. Again, I've got the 50 and the 100-day moving average. So we've got the strong rally off the 100-day moving average, and prices are within 1.5% of a new all-time high. As I said last week, try not to get swept up in other people's fear. Know where your exits are, follow your plan, and make rational, unemotional decisions. That's how we see off. Well, that's how we potentially see off these periods, and how we manage risk. Is this rally the real thing? Well, starting with the S&P 500, as it stands, the uptrend that began back in April, this uptrend remains in place. It remains intact. All we have at this point is a pullback to the 100-day moving average. You can see a similar example back in, look at this similar one back in April last year. Price was at all-time highs, came back to the 100-day moving average. Looks pretty similar, doesn't it, in terms of proportion and time, and then it was off and away again. Like you can find other ones in here too. Like there's another one from September last year. Just go through, like moves back to 100-day moving averages and ongoing rallies. It happens during bullish trends. It's how a lot of bullish trends move forward. Whether this current episode leads to a big ongoing trend, well, of course that remains to be seen. But I think that at this point, the evidence suggests that this remains an uptrend. Nothing has happened to change the trend from bullish to bearish at this stage. The biggest concern about the trend has been the persistent fall in participation. This is something we've discussed in quite a bit over recent weeks. In fact, over the last 3 months of this rally in the S&P 500, the rally has been more about the so-called Magnificent Seven, Nvidia and the like. It's been more about them than the broader market. And I think for a healthy bull market, it really does take that broad participation, a wide range of stocks rallying, not just a few big caps. I think the good news on that front is that there are signs that the broader market is starting to rebound. So let's have a look firstly at the equal weight. This is the S&P 500 equal weight. And last week I was talking about this breakdown. We had a 2-month trading range in the equal weight, and last week we were talking about this breakdown from that range, and I said that was a sign of technical weakness and something that we couldn't ignore. But look at what's happened now. Look at what happened in the last week. The equal weight has now had this strong rally off its lows and has, first of all, the breakdown didn't attract follow-through selling, and prices have now rallied towards the top of the old range. We can now say, I think this breakdown was in fact a false break. Now, false breaks to the downside are often a bullish signal. A false break tells us that that the selling pressure was quickly exhausted, no follow through selling, and that the dip was strongly bought. Hence, you got that strong snapback and the failure of the breakdown. Now, the rally in the equal weight, it's also a sign of participation broadening. So this week's rally isn't just about a surge in Nvidia or one or two other big caps. To get the equal weight moving, you need a large range of those S&P 500 stocks rallying. Can't just do it on one because it's an equal weight index, and I think that's what's needed to stabilise the market, push things high. You need that broad participation. Having a look at an indicator, we looked at this indicator a bit in recent times. This is the percentage of Russell 3000 stocks above their 100-day moving averages. Now, the Russell 3000 is a broad measure of US stocks, not to be confused with the Russell 2000, which is small caps. And we've been discussing this declining trend over the last few months, and this has been pointed to the current consolidation. But look what's happened. Well, look what's happened this week. This is what we've been waiting for, and it's all unfolded in the last few days. There's been a strong reversal in the indicator, and there's been a surge in stocks that are above their 100-day moving average. So the percentage of stocks above their 100-day moving average is increased from 35 up to about 52% in just a week. As we discussed last week, moderate pullbacks in the market often end in this vicinity in terms of participation, where participation comes down into the high 30s to maybe the high 20s. This is generally where a lot of modest consolidations or pullbacks finish. I think the key for an ongoing bull market is for the percentage of stocks above the 100-day moving average to become established above 50%. And then once established above 50%, start moving up into the high 50s, 60s, and so on. That's where we can get an ongoing bull market from. Just a quick graph to finish up on the US market, which I saw this week, which I thought was interesting. Came up on my Twitter feed. Now, what this shows a spike in volume. So up the top, we've got the S&P 500. Down the bottom, we have the volume traded in put options. And this week there was a spike in volume. Now, if you don't know, put options are a bit like portfolio insurance. People buy them when they're worried the market may fall. And a spike in put options, a spike in the volume, it's a sign of fear, and it's often the greatest near notable lows. So this goes back to 2022. It's just a snapshot. I don't think it's like a tremendous indicator on its own, but it is an indicator of there's been quite a bit of concern out there. So look at some of these other previous spikes. It's coincided with the lows around April. Other low points which have been coincided with spikes. Look, there are also times where there's elevated, like quite high put volume as well, where the market just has a bounce and then continues to fall. So it's not going to pinpoint a low for us, but it does tend to occur. Lows do tend to occur when put volume is excessive. And that's because it's people are fearful. People hedge their portfolios or punt on a declining market with put options. So just something interesting to take note of how much fear has probably been out there. Coming back to the S&P 500, as it stands, we've got a pullback within an uptrend. There are also signs of that increasing participation, which is positive. As I said earlier, Don't get swept up in other people's fear. Have a plan. Apply that plan when the market is good, and especially so when the market gets tough. When it gets tough, apply your plan. Have the discipline. Stick to your plan. See it through. It's about sidelining our emotions and managing risk. And if we can do that well, then the pullbacks become, they're never enjoyable, but they become more tolerable. So yeah, have that plan. Okay, so we're going to jump over to the US small caps now. We're going to cover the local small caps, the emerging companies. We've got the commodities. We're going to go through copper, gold, oil, uranium, all your stock codes. All that is still to come. But of course, that wraps up the free section. If you're not a strategy session member, it's going to cost you a little bit of money to come in for the rest of the session, and we're going to go through a whole lot more stuff, maybe even some of your stock codes next week. If you join up now and come in for the live session next week, we'll go through your stocks too, if you'd like. But okay, over now to the let's start with the Russell 2000, the US small caps.